I've been investing for decades and have dabbled in almost everything, including stocks, bonds, options, futures, forex, and digital currency. And I've learned a few things by losing a lot of money and making a lot of money. And I want to share what I think would be a good strategy for someone who wants to retire early or anyone who just wants to make a steady monthly income from their investments. I'm not selling anything, I just want to share my knowledge from the School of Hard Knocks. Let's work with some numbers. The average retirement savings for someone 55 and above in the United States is about $185,000. Is there a way you can put this money to work such that you can get $1,000 a month or $12,000 a year of steady income for the rest of your life without ever touching the principal? The good news is you can, but you have to do it in a smart way so as to minimize the risks and definitely avoid some investments that can be pretty close to being scams. I'm going to show you a way you can do this and minimize risk coming up right now. One of the essential things I've learned about investing is that the simplest strategies tend to work the best. And in fact, the more complicated the investment, the more likely you are to lose money. That's been my experience. In order to generate $1,000 a month from $185,000, you have to get a return of 6.5% per year. How is such a high return of 6.5% possible when the best possible rate you can get from savings at a bank is closer to 2%? There are ways, but you have to be willing to take some additional risk. Smart risk. When I say risk, I don't mean risk like gambling your money at a casino where you can and you will lose all your money. By risk, I mean the risk of losing some of your principal on paper because it can sometimes decline in value due to market fluctuations. When you invest money in a savings account at a bank or money market, one of the guarantees you get is that your principal of $185,000 will never go down in value. You will always have at least $185,000 in your account. You might not be able to access it for 6 months, for example, if you buy a 6-month CD, but that money is always there guaranteed. This is called safety, which is short for safety of principal. Now, the price you pay for this safety is low returns. In order to get a significantly higher rate of return, like 6.5% instead of 2%, the compromise you have to be willing to make is to forego this 100% safety of principal. You have to be willing to let your $185,000 fluctuate in market value, at least on paper. But what you should know is this: you only lose money if you cash in or sell your investment. This is something that most investors don't understand. The value of your principal is only locked in when you cash out. But in your case, you're interested in making a steady income for the rest of your life. So the money that you will be investing, $185,000, is not something you will want to access, but rather leave right where it is until the day you die, because it's going to be working for you. So its paper value makes no difference to you. The only thing you're concerned about is the $1,000 a month that the investment is paying out to you. You will not touch your principal ever again. If you get this, then you'll understand how this compromise is a smart investment strategy. Now, there's good risk and bad risk. Bad risk is putting all your money in only 1 or 2 types of investments, or worse, putting it all in 1 or 2 companies. Rather, a smarter way is to diversify your investments by putting your money in several investment classes and several companies. This diversified investing is the key to smart investing because it will reduce and mitigate the risk of market fluctuations and increase the safety of your principal. How? Because it is less likely that you will lose all your money, because even if one company or investment in your portfolio goes bankrupt, your whole portfolio will not drown. So what are some of the places that you can get a 6.5% annual return with a diversified investment portfolio? Here are some places where I would put my money if I wanted this level of return within an acceptable level of risk, and some places where I would not put my money. I like closed-end funds, or CEFs, because they provide good returns with acceptable risk. I like closed-end funds offered by BlackRock because first, they've been around for a long time. They mitigate risk by investing in multiple stocks and bonds, and they enhance returns by borrowing money. Borrowing money to make investments would be a risky strategy if you did it on your own, but it is lower risk in a fund because they're buying dozens of securities with tens of millions of dollars, not just a few that you would buy if you were doing it on your own. Their corporate yield fund, for example, invests in corporate junk bonds, which are considered risky, but this risk is reduced because they're buying the bonds of dozens of different companies. So even if one or two companies cannot pay its bond interest, you will still get your money from the other companies. Here are two of my favorite closed-end funds from BlackRock. BlackRock Corporate High Yield (HYT) invests in junk bonds. The yield currently on that is 8.5%. There's also BlackRock Enhanced Equity Dividend Trust, which has a current yield of 6.6%. This fund invests in high dividend paying companies, and then they borrow money to increase their returns. I also like another fund called Invesco CEF Income Composite. Now this fund is a little bit different because it is a closed-end fund that invests in other funds. So this reduces risk even further. It's a fund of funds. This closed-end fund has a current yield of 7.7%. If you're a bit more risk averse and you can't stand to see that principal drop in value even if it's on paper, then you can invest part of your money in short-term treasury bonds. One good exchange-traded fund is called the iShares 1 to 3 year Treasury Bond Fund. This has a current yield of 1.72%, but I would only invest a portion of your money in this fund just to mitigate risk. Where are the investments to avoid? 1. Don't put all your money in the stock market. It's too risky. Although over the long term you can get an average of 7% annual return, if you're looking for steady income month after month, it will not happen in the stock market. 2. Don't put all your money in long-term bonds. Paradoxically, this is also too risky. What many people don't understand about bonds is that they can decrease greatly in value in economic conditions where interest rates are rising, like they are right now. And number 3, annuities. Now, your insurance agent will push for these. Now, although these will result in steady income for you the rest of your life, the actual rate of return on these is quite low after you take into account the often hidden costs that are not disclosed to you by the agents, and they will keep all your principal. Annuities are a type of life insurance product. In my opinion, they're better options. Now note, the information presented here is for information only and should not be construed as financial advice or recommendations to buy or sell any stocks or securities. I'm not a professional financial planner, and you should always do your own further research before making any investment. All I'm offering is an opinion from my extensive education in the School of Hard Knocks.